I am, dude. I'm so tired. I know you're tired too. Yeah. No, yeah, I got you. So, going into just liquidity only, we're not looking into using liquidity as stops or targets or any of that. Just solely looking at where liquidity is on the market. I like to use the 15-minute chart because the 15-minute chart um, during Asia or even during the beginning hours of London, right, will show you a very good idea of where our liquidity is resting in the form of external range. So remember, every PD array, higher time frame PD array, has an external and internal range. If you go to the 4-hour strat, right, what are we looking for? We're looking for a sweep of that external range. So what is the external range? It's the previous high of the 4-hour and previous low of the 4-hour, right? We're waiting for us to manipulate above, drop, or manipulate below and rise. So if we're looking at that strictly liquidity standpoint, we're just looking for a higher time frame PD array. So up here on these X's that I have marked out already, this is where our previous liquidity is resting, our higher time frame liquidity. If we go even further back, right, we can see where our liquidity is resting. Our liquidity is resting where? Above Asia and below Asia. After Asia, right, if we just keep going backwards and backwards and backwards, we have all of the liquidity that is resting here and all of the liquidity that is resting here. So just from this standpoint alone, right, we opened, here's Asia, London, New York, we opened, and after the day closed, we did what? We left all the liquidity in the form of a higher time frame PD array. The session, New York, New York, London, Asia. We have a bunch of liquidity resting underneath here and a bunch of liquidity resting right here. This is all-time high. A bunch of orders resting up here, right? Liquidity is literally just buy stops, sell stops, limit orders. It's just a bunch of different orders that you are, my daughter came in. It's just a bunch of different orders that are, chilling. It's liquidity. I mean, have you ever put an order in for a scalp or even for a short order and it goes to your order right away and you're targeting the recent high or the recent low? Well, the reason why the market goes straight for those recent highs or for those, let me zoom out a little bit so you can see this, those recent lows, right? Look, see this low right here? So the reason why we go to that is because that's where all of the limit orders are that are getting ready to go the same way. So for example, when we shorted, the liquidity that is here are short orders. There are people selling and trying to short the market. So remember, we're trying to trap liquidity. So what happens when you short, and then of course you go the opposite way, right? You hit people's buy stops. You hit their stop loss. You hit their break even when they go into profit, right? A lot of traders go into break even so they don't lose any money. Well, the market, it's engineering that liquidity. It's forcing everyone to go long and put their stops in profit or break even only to take them out. So it does a twofer, right? It makes you get in and then it forces you out. Remember, whenever you buy an order, someone is selling. Whenever you sell an order, someone is buying. So there's all kinds of people waiting at Asia high to go long. Now, those people that are getting profit, taking money out, like I took this trade and I made some on this long, it doesn't mean that, I'm wrong. It just, my order that I sold is still getting bought by someone. So even though I'm coming up and I'm getting profit, it's still getting sold up in this area, which is what the manipulation area where all of our liquidity is resting. Then, after we take that liquidity, we want to grab the resting liquidity on the opposing side. So what do? We dropped, we took this liquidity, created a gap, right? This is just a 15-minute. I mean, if we go to the 4 hours, it's a giant candle. But again, the 15-minute is what I like to look at. So the liquidity was taken here, here, And then remember I showed you back there those liquidity. So we dropped so hard. Of course, everyone's like, "Oh man, we were at all-time high. We were bound to drop." Well, I mean, if you look at the chart, we were at all-time high for a long time, and we did not nearly drop as hard as we did this day. So the whole time that we were engineering and generating liquidity, right? We take out the opposing side and then we take out the opposite, 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 right? Opposite, opposite. We keep taking out liquidity on both sides so we can accumulate short orders on the way up and then leave everyone that thinks we're going to go higher standing with the bag, and then we drop. And then here is an accumulation of long orders, which we already know. This is accumulation of long orders. Why? Because on Friday the market went straight up. So when you're thinking of liquidity, you're really, Dan, you're really only looking at the 15-minute session high and session lows. The daily chart is fine. The weekly chart is fine if you're close to it. Like right now, right, this is the weekly, this is Monday low over here. So if we come back this way, this is Monday right here. Oh, sorry, this is Monday. This is Monday low, right? This is Monday high, Tuesday high, Wednesday high, Thursday high, Friday high. I would not even think about attacking liquidity on Monday low because look how far down it is. It's 20,592 is Monday low, and then Wednesday was 400 handles higher. I'm not even thinking we're going to get close to Monday's low. So I'm looking to generate liquidity in the form of taking out longs. Because, like I said, all of these is literally just liquidity. It's just liquidity everywhere. This is all your liquidity. Now, this is all your external liquidity. Then we go into internal, right? And that's when you go into the higher time frames. So let's go to the 1 hour, and then you can see that all the gaps on the 1 hour, right? This gap here, fair value gap. Let's see, there's another big fair value gap. There's another tiny fair value gap here, right? But if we map it out, here's our fair value gap. And we go down to a smaller time frame, we can see how, oops, when we came down, that area caused us to not bounce, but that area caused us to stop and not knife like everyone normally sees, right? We didn't knife, we stopped around the area breaking through it because we're taking up all the orders. And then when we break into that fair value gap, we start chopping around in it because we're taking everyone's liquidity, right? All their buy stops and sell stops in the form of that gap that was back there. So when you think of liquidity, you really, really only have to think about external range liquidity and internal range liquidity. After that, you just go to a higher time frame to map out your targets. The higher time frame is where it's at for your targets. So if we go to the 4 hour, right? Obviously we drop and we have this big giant candle here. This would be our first target, and then this one right here would be our next target from a higher time frame perspective, right? Now if we go into the 1 hour, we can see we have a couple more targets here, right? And what are our targets? Our targets are literally just the fair value gaps. So this would be a price target up, right? There's a fair value gap there, fair value gap here, right? That's the close and open of the fair value gap. And then if we look here, that 4 hour high is the same on the 1 hour. So these are our targets on the way up. Our goal or our targets to go higher before we can see any type of rejection or retracement. And if it is a reversal, we're going to see them at these levels. You're not going to see a reversal in the middle. You're not going to see a reversal in the middle. When you have a big ass fucking gap like this, yes, you will see one at where the consequent encroachment, or if you're mapping it out correctly, right? If you map out your PD array, then you will see it at your equilibrium, right? So, yep. So if we keep going up, yep, right here. So if we keep going up, right, we're gonna let our hourly chart go because we already knew what happened. We already know what happens. But going back, we can see how we respect and how we react on these imbalances when they get filled. Obviously, this is the 1 hour, so it took a long time for all these candles to get created. But if we look solely at where we stopped, where did we stop, right? And then if we pop back up here, look at where we stopped again. And look at what we could not break, right? And then look at where we dropped. Look at our body. And then once we broke above into this big imbalance, right, this big giant one, where did we end up stopping? The 50%, right? This isn't even the 50%. The 50% is actually like, I think like right on the touch. Yeah. So after we hit, right, that equilibrium, after liquidity, after we took enough liquidity, then we dropped. And when we dropped, right, let's get rid of all this stuff now because remember we took all these targets to the upside. When we did drop, where are we dropping to, right? Here's, again, the 1 hour. Here's liquidity. Here's liquidity. The reason why this fair value gap I consider liquidity and not all these buy stops and sell stops that are getting triggered because the market is creating imbalances and filling them out. So it's creating an imbalance and filling it out. And then when we create new imbalances, we have to fill those to create what's called a balanced price range. This range here is balanced. That means that if we return back to this range, there is a very high probability that we are going to bounce. We're going to bounce up. So if we remove our drawings and we literally use the last point of the balanced price range, we can see where our candle body, right? Because remember, the wick does the damage. We can see where our candle body caused the reaction for us to fly off of it, or for us to stop before creating on a lower time frame our entry to go lower. So let's see what our next candle is, right? Look at our body. Look at our balanced price range, right? This is our balanced price range. This is our liquidity down here. This is where our liquidity stops, or starts, sorry. But this specific line that I drew here, this is where our price range is balanced. All of this underneath is balanced. There's no reason for us to displace. Not displace into it, but there's no reason for us to displace inside of it. So all of this range right here, and you'll see this a lot in Asia, the end of the day and Asia and the beginning of London does this. All of this area right here is balanced out. So if we are going to go lower, we are going to chop around this range because there's no liquidity in it. So we're going to chop around because we have to displace higher and lower, taking out external range in the form of hourly, 4-hourly candles. We're going to create them inside of this balanced price range, and we're not going to have a nasty displacement like this because this displacement here, this big one on the 1 hour, was to take out this liquidity and to tap into this liquidity here. So we tapped into it, and then like I said, the body, look at the body, never closed, never closed, never closed, and then we just kept continue going up. Does it make the liquidity make a little bit more sense now? So that's So again, looking off of this example that we just used, right, the balanced price range, and then coming up and creating an imbalance and then filling it, the same thing happened here. Same exact thing. We created the balanced price range, which is this high and this low, right, this doji. We created a balanced price range. So on a lower time frame, what we're doing here, going up, down, up, down, up, down, is we're chopping, right? We're chopping it up, and then we displace. And then we chop up, and then we displace. And then we chop up, and we displace. All we're doing is moving from external to external range, taking out the liquidity that we're generating. We're engineering all the liquidity. And then when the NY, sorry, I didn't snap my fingers. Then when New York opens, we create that Judas that takes out the external range and then attacks the unbalanced, right? The imbalance. It attacks the imbalance of the range. All of the liquidity that was down here that it needed to take to go higher. So I'm bullish, right? I'm bullish. We still have a crazy, crazy uptrend. But this big drop is just showing me that they are engineering liquidity to make the market go higher. So your liquidity pools, right, is literally the 15-minute highs and lows. Find your balanced price range. And when, like the notes I showed you, around 8 o'clock, 8:15, even 8:20, if you look, you can see what the market is doing and how it's engineering all the liquidity. Right? If we wake up, this is the hourly, we'll go to the 15-minute real quick. If we wake up, and again, we already know what happened, but if we wake up and the news already happened, right? Like on this day I woke up, and this is when I was explaining to the guys in the group, hey, look at manipulation. It's to the lower side. I think we're gonna go up, and then we had a crazy open. Well, we can see that exactly like I showed you. We created a balanced price range, and then we manipulated lower, and then we're gonna go up. But where are we gonna go? We're gonna target our imbalances. And then all we do is map out our PD array in the form of the previous day, and it gives us a very good idea of where price wants to go, which was the equilibrium. So that's liquidity. Any questions so far? Okay, so liquidity is to be used as targets. I love to use liquidity as targets. I love to fill them. A couple ways you can enter off of that is, of course, the inverse fair value gap. The way that I showed everyone how I use my change in state. If you map out your change in state correctly, which is something we'll go over later, when you map out your change in state correctly, it respects all of your zones, and you're able to hit your liquidity targets going up, but you're able to follow the retracements down. Excuse me. You're able to follow your retracements down to get another entry for the leg up. So your liquidity is to be used, your internal is to be used as targets, and your external is to be used as the point of manipulation. So liquidity has a couple things that we're going to use it for. But like I said, the biggest thing is the 15-minute, the 1 hour, the 4 hour, right? Those are going to be your daily targets. Those are going to be your daily liquidity targets. If we go back to that crazy drop, trying to think of where I posted it. If we go back to that crazy drop, right, and we look at all the targets that I had, they were literally just the 1 hour and the 4 hour. This was my 4 hour, right? We tapped it. This is the 4 hour low, 4 hour high. So what did we do? Right? We ended up filling it, right? I believe this is like the 1 hour chart right here, but the 15-minute. But we filled it, right? And then this was my dole. But what was my goal? My goal was literally just the fill of a fair value gap. This equal low, right, was the only thing that's different than liquidity. But the new goal was the 4-hour high of the fair value gap. And then the 4-hour fill, which was my new goal, the 4-hour fill was literally just the bottom of the fair value gap. And then my ultimate TP was literally just the daily fair value gap. So all of this was exactly how I'm explaining it to you now. Our external range, where we took it out, forcing longs, and then we filled the imbalance we created, and then we filled all the other imbalances. This, yes, this was overdue, but we were able to catch it, right? We were able to do it and catch it because we understood how liquidity worked. We understood the targets and how to get in. So this technically could have happened any one of these days because we were at all-time high. The fact that it happened on Thursday with news where they were like roasting Jerome Powell, is it a coincidence? I don't think so. But we're able to identify all this shit that happened because we have a higher understanding of just liquidity. This has nothing to do with concepts at all. Besides liquidity, this has nothing to do with entry models, exit models, take profit, risk to reward, none of that shit. This is just liquidity. Now, when our targets are met, right, you can scalp from liquidity to liquidity. If there's a nice imbalance that you see, and you'll start seeing this more, that you know is going to get filled, you can scalp from liquidity to liquidity pool. You don't have to have an entry. It's going to be scary. It's going to feel really weird when you do it, and I'm going to have you do a couple more towards the end of the week. So like Wednesday, Thursday, and Friday are really good scalping days because there's a lot of liquidity generated in the week already. You already have Monday, Tuesday, and part of Wednesday, and it's really easy to scalp imbalances. You're literally going to get in when we get into the imbalance, and then we're going to get out when we get out of the imbalance. And it's a lot of how I make a lot of my plays. Bro, like I don't even have an entry. I just, oh fuck, we're gonna fill this imbalance. I can see market structure. We just had a new leg up, dude. We're gonna come back and take this liquidity before we go higher. I'm just gonna fill this fair value gap, and I'll take that shit. That picture that I just showed you right now about this, the 4-hour fill from 589 to 517. I took that shit. I got in. No, I knew. Again, you're gonna see this. I knew we were gonna fill this fucking gap, bro. I knew we were gonna fill this shit. Even after all this, I was like, dude, we're gonna continue lower. I'm gonna get in. I'm gonna get in light, but I'm gonna get in. I took this for like 40 handles off of 2 cons, and this was at work. I was at work. I think I was like making my lunch. I was making like ramen or something, and I looked at my phone and I was like, holy shit, she's gonna fill, and I got in. I got in when we tapped in here on the noodle. I got in and then I got out. I got out earlier than 517. I think I got out like at 525 or something like that. But I was like, this thing's gonna fill it, bro. And I just fucking took 2 cons and just rode that shit down. Got out. So let's see what the market's doing right now. So right now, we had a nice little push up, taking out this big candle that came out. So what are we attacking, right? We still have on the 15-minute, we still have this very big imbalance here. So if we are to continue lower, where is the big possibility for us to reverse, right? Or retrace? Coming up to it right now, 591. We're at 586. We're literally right there. This is where I would like to see a retracement or some type of reversal here. Now, this is a big imbalance that we have to fill. But you also have to remember, we still have this big imbalance to fill down here. Right? Now, if we look at ICT, right, the low-hanging fruit, what is the probability of us going higher? Remember, in order to go higher, we have to go lower. So for me, if I'm going to hit this high, I want to see us react here and then fill this and then go higher. Because that would balance out this price range. Then on the way up, we will fill this imbalance to take us to external liquidity, which on the higher time frame is the leg up and the leg down. Right? The big drop we had, and then the retracement of Friday, and then if we fill this up, right, this part here is this move up, and then the next leg down would be what? Tapping or falling short of breaking the high and then coming straight down. Okay, so that's liquidity. The next thing that we'll go over like one more thing, and then we'll talk a little bit about the everyday model. So, I don't know how tired you are. I don't know how much you want to go, how far you want to go into it, but we can go like it. Okay, so the next thing that we want to talk about that I want to talk about is rejection blocks. How much do you know about a rejection block? So you want to go to what the hell? You want to go to? Did you see that? Thanks, Dad. Um, you want to go to your 5 minute time frame, right? And you want to find. This is gonna sound funny. Something that sticks out. So if we look at how this bad boy sticks out, right? This tapped something and it dropped. What did it tap? This was a gap up. I think this was market open actually. So, but we also tapped something, right? We tapped something and then we dropped hard. We hit internal liquidity and we drop. Up here, right? We took out London and we dropped. So there's a lot of areas where a rejection block can form. What you want to look for is you want to look for the rejection of a high. Easiest way to form a rejection block. So if this London, right? If London here, oh fuck, I think a mosquito just bit me. So this London high, if we would have fell short and not filled it, it would have created a rejection block in the form of, if you're bullish, your last up close candle. So it would be this one would be our last up close candle. This would be our rejection block. And if you're bearish, it would be your last down close candle. Right? So your close of your up candle or your close of your down candle. That's what forms the rejection block. These rejection blocks are momentum shifters or momentum changers. And it'll shift the tide, and it'll also allow you to see where we are distorting time. So time distortion, right, is when we, and I talked about it in the chat, time distortion is when we accumulate all of the buy stops and sell stops in the form of rating internal liquidity. So what we're doing is, right, so here is a rejection block, and our rejection block is actually right here. If we map it out, we can see that our last down close candle, mapped out, keeps getting rejected. We can close under a rejection block. We just don't want to have a continuation under it, right? If we have a couple more candles that close under it, then it's kind of a, oh shit, we broke the block. But your 5 minute, right? I don't know why it's calling me. Yes, babe. Okay, I'll be right there. My son is crying. Let me pause this.